Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and welcome back to our special series on how to invest. We started with creating those financial goals in our last video, and today I'm going to show you how to invest in stocks that fit those goals. For this video, I'm going to keep it at that bird's eye view of how to invest according to those goals and your age. So I'll show you how to really customize your portfolio with the right levels of stocks, bonds, and real estate, as well as how to invest in stock sectors for diversification. In our next video, I'll reveal how to compare individual stocks against each other so you know you're only investing in the very best. And the idea here is that we're using this 3-video series to create a complete guide on how to invest, from those higher level concepts like goals in a portfolio all the way down to which specific stocks to buy. So make sure you catch all 3. In fact, I've included a link in the video description below to a free checklist that you can use to follow, so look for that link below. Before we get started though, I want to send that shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So nation, I know right now everyone is all in on stocks. The market just had its best 3 months ever, jumping 36% in the 12 weeks since March 23rd, and you've got some stocks posting 20 and 40% gains in a single day. Why would anyone ever think about investing in bonds or real estate or anything other than stocks? Well, because we all know that the market can and does go the other way by a lot. Having investments in not just those other assets like bonds and real estate, but finding the gaps in your portfolio and investing in different sectors of the economy, it's going to help you cushion that fall when stocks aren't that one-way ticket higher. What I'm going to show you in this video is going to protect that hard-earned money and give you the opportunity to take advantage of those lower prices in stocks when the stock market crashes again. We'll be using the Let's Talk Money portfolio tracker for the video to put in your portfolio or the stocks that you're thinking about buying to see how they create that perfect portfolio for you. The spreadsheet is going to show you how much you have in those assets and the sectors, as well as the gaps in your portfolio. And part of this just fits in with our last video on goals. If you go back to that investing goals tab, the spreadsheet brings in your current portfolio value and uses the historical returns for those stocks, bonds, and real estate to estimate exactly how much you're going to have in retirement. I'll leave a link to download the spreadsheet in the video description as well. This spreadsheet was 3 months in the making and includes some great features, so make sure you check that out. So we're here in the portfolio tab, and I'm going to use the stocks from a friend's portfolio as an example here. Now, Steve has 26 stocks and a lot of those popular names like Carnival, Tesla, and Southwest Airlines. I put in the number of shares and the price paid for each, then I click Load Stock Data. Now, the spreadsheet is going to update this with the current price and all this other information, including the sector and the industry. I can also scroll down here and put in some of these non-stock assets here like Bitcoin and real estate property. Steve has about $175,000 in equity on his home, so we'll use that in here and estimate the long-term return on 8% a year on that money. And the first thing we can do is scroll up and look at how much Steve has in each stock. Not the dollar amount, but the percentage of his portfolio in each company. Of course, everyone in the nation knows my rule for this, that no single stock should make up more than 10% of your portfolio, and that's an upper limit. I'd actually say even less, maybe no more than 5%. The last column here, this color-coded, is 3 to 5% as yellow, 5 to 10% as pink, and anything over 10% of your portfolio is going to show up in red here. And we immediately see here that Jeff has more than 40% of his portfolio in shares of Amazon, which have done really well over the past few months, but it's still a major risk for his financial future. Now, I agree totally. Okay, I think Jeff Bezos is going to rule the world someday, and the company already owns pretty much everything, but think about this. Okay, if Steve here has 40% of his portfolio, 40% of his stocks in this one stock, in Amazon, if for some crazy, unforeseeable reason in the future shares of Amazon drop by half, he's going to lose 20% of his portfolio, wiped out in the blink of an eye. This is why I say no more than 5 or 10% in a single stock at the most. People have lost their entire life savings in stocks like Enron and Lehman Brothers, or even stocks that didn't bankrupt but just dropped hard like GE or Research in Motion. So we know we need to get some of this money out of Amazon to spread it around a little bit, and we can go to the Portfolio Overview tab to see more gaps in the portfolio. So this first section shows us how much we have in each asset class, and we see that Jeff has half in stocks, the other half in his real estate equities, but no bonds or other assets. Now I'll show you some guidelines for how much to have in stocks, bonds, and real estate depending on your age and later in the video, but this is obviously something that we're going to need to fix. And we can scroll down and see the portfolio by sector of the economy also. So the percentage of each sector in the portfolio and compare it to the weight in the broader market, that S&P 500 index. So we see that Jeff has 70% in tech stocks, and this is something I see in a lot of investor portfolios, just way too much in tech. He's also got some of his money in stocks of consumer cyclical companies, communication services, and industrials. And the idea here is that we're going to use this information to see what gaps there are in the portfolio and what stocks or funds he needs to buy. Now, I'm not saying you need to have stocks from every sector or close to the percentage that we see in the sectors in the stock market, that S&P 500 comparison, but having all your money in stocks or all in just a few sectors is going to set you up to lose a lot of money. So from that investing goals tab, we see that Jeff is 49 years old here and actually doing pretty well. He wants to retire in 15 years. He puts about $1,000 into his account each month, and the spreadsheet is taking that $308,000 portfolio that we saw earlier. It's using the historical returns and tells us that he can expect a portfolio of nearly $1.5 million by the time he retires. So now this is actually going to surprise a lot of investors, but it is extremely important, seeing where your portfolio is now, what you can expect in retirement, and being able to match the risk in that. So if we look at this, it's not like he needs a lot of risk. And maybe he wants to think about investing a little bit more in some of those safety sectors like utilities, consumer defensive, and healthcare. Taking some of this money from tech stocks, which can be extremely risky, and putting it in these other sectors. That's going to give him the opportunity to stay in stocks, but with a lot less risk. And we saw he also needs some of that exposure to bonds to cut that risk further and protect that hard-earned money. So what I'm going to do is, in this example, I'm going to go to the portfolio tab. I'm going to sell down these Amazon shares to about 10% of the portfolio. So I'm going to sell it down to about 6 shares and then put that money in some bond funds and ETFs of a few of the stock sectors. So we'll use this Vanguard Long-Term Bond Fund, the ticker BLV, for our bond exposure, the Spider Select Sector Healthcare Fund, ticker XLV, the Select Sector Utilities Fund, ticker XLU, and then the Select Sector Consumer Staples Fund, that's the ticker XLP for those sector stocks. And if we go back to the Portfolio Overview tab, we see that it now includes those position in bonds, even if it's only about 5%, so we'd probably want to increase that a little bit more. We can scroll down and see that we've lowered the percentage in tech stocks to about 17% and included some diversification in some of those other sectors. Now with that, I want to give you some quick rules of thumb for how much you want in each of these. Okay, so how much to invest in stocks, bonds, and real estate according to your age. Understand that these are only rough guidelines here, so feel free to have a little bit more or less depending on what works best for your goals. For the younger investor in their 20s or maybe 30s, you've got decades to invest, and any single bear market crash really isn't going to affect you that much. Even if stocks tumble, you'll have 30 years or more to ride out those prices higher, and it means you can have more in stocks and not worry about the risk. So that generally means between 60 to 75% of your money in stocks, maybe 10 to 15% in bonds. This bond portion of your portfolio here is really just to cushion you from those big stock market crashes and then give you that cash to take advantage of those lower prices when they do come along. Now here I'm recommending between 15 to 20% in real estate for that extra diversification and the cash flow. I know a lot of investors have more in property or real estate stocks, and I think you can take it up to maybe about a third of your portfolio if you like, but not at the expense of that bond portion. As you get a little bit older, maybe in your 40s and 50s, you want to start dialing back the risk in your investments. You're still looking for that return on your money, but you also want to make sure that the money is going to be there when you need it. Now, for that reason, we've brought the amount in stocks down to between 45 to 65% and increased the share in bonds to 15 to 20% of your portfolio. We've also increased the percentage in real estate a little bit, between 15 to 25%. We've also added a 10% cash cushion here for unexpected medical expenses or just short-term cash needs, like maybe paying your kids' college expenses. As you age into your 60s and then beyond, your priority is going to be protecting that money that you've earned and just keeping up with inflation. You still need some kind of return on your money, especially if you haven't saved much, but job one is definitely making sure that you don't take any big losses on your portfolio and you can cover your living expenses. So here we've reduced the portion in stocks to between 30 and 50% and increased your bond allocation to 20 or 30% of the portfolio. We might have maybe between 15 to 25% in real estate as well, which is going to help you with those cash flow needs. Here we'd also maybe have at least 10% of a cash cushion and probably more for those near-term expenses. Don't forget to look for that link in the video description below and get your free checklist for all 3 videos on how to invest your money. Stay tuned for our next video on comparing stocks so you invest in only the best, and join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.